Good morning. I will try to describe the changes in the Israeli pension system over the years and try to deal with the possible solutions for the longevity issue, which is a big issue. I think in the modern world, one of the things that we haven't found a solution is for the longevity. It's something that because of the transitions in the models in the pension system all over the world, the pensioners haven't felt the full impact of longevity, and it's something that I think throughout the world we'll have to come with some solutions in order to deal with this problem. I'll start by describing the pension system from early ages. I think the early pension system was the family cell, the tribe or the family cell, which was the first pension support. The elders of the family were supported by the younger ones over the years, but the risks of the pensions, I will afterwards address all the risks in the pension schemes, but the risks were upon the family cell or the tribe. For instance, if the elders lived longer, then the tribe or the family cell would support them until the last day. At the 19th century, Bismarck came with the idea of state pension, and he issued a pension plan by the state that gave pension which was predicted upon longevity of 65, which means that you are getting pension starting 65 and on. The longevity at that time was something like 45, it wasn't a true pension scheme, but it was something that came close to it. It's interesting to mention that most of the principles that Bismarck ruled on his scheme stayed up until today, which is the 65, which is the 2% accumulation of pension rights, which is the last salary system, and so on. And in the recent years we see, because it's not a stable scheme, either companies, either the states will have to deal with the problem. I will deal with or address it afterwards. In Israel, one of the things that has been done is changing the retirement age and changing all the pension schemes in Israel over the years. So when after Bismarck came with the pension scheme, we see over the years that the employers joined and built the pension schemes for the employees, each employer for his employees, and we see that the risks of the pension schemes are borne by the employers. Most of the schemes we see at the employers is a DB plans, which is defined benefits, and also over the years we see that the DB plans, because they are not managed like a proper insurer without dealing with longevity over the years and other risks in pensions. The most famous one is Maxwell, but other cases, if we see GE and other big companies, they are unable to deal with the risk in the pension plans, and over the years, and we see it in Europe also, the OECD, they start to move to DC plans rather than DB plans, the benefits from such a transition are two. One is a DC plan is much more balanced plan than a DB plan. In other words, the risk is upon the employees, not on the employers. The second one is the ability to give the employees a full ability to move between the employers without hurting or causing any damage to their pension schemes. Because if you are getting a pension from employer, you are getting it only, there is a vesting of at least 10 years and so on. It's very harsh conditions if you leave the employers. So by moving to DC plans, you are getting much more free labor market than you had before. In Israel, we also had all kinds of pension schemes by employers. For instance, transportation companies, hospitals, and so on. But they all came to bankruptcy, which means that in 1995, the government of Israel decided that all these plans will be shut down for new participants, and the old pension schemes under government support will come and get into a run-off program. And at 1995, the government established a new pension, which was based on a DC plan. And once again, if the risks were up until then on the employers, now the employees or the participants in the plans bear the risk of longevity. In Israel, there was also, I think in other countries, there is also a state budget pension besides the social security pension. In Israel, the model of the three pillars is that the first pillar is a flat rate pillar of social security, which is not enough to maintain a pensioner. The second pillar is a DC plan or a state budget or employer's budget up until 1995. And above it is the free assets of the pensioners. The government in 1999 also closed the state budget pension, and starting 1999, all the employees in the government sector, along with the private sector, are now insured in DC plans, which are all private disciplines held by the market or managed by the free market or private market in Israel. What we see today, or if we are dealing with the pension risk, we see that there are four major pension risks that we have to deal with. The first one is death before retirement. After retirement, it's longevity, disability, life expectancy or longevity, and investment. The system in Israel was system, or the pension schemes in Israel dealt with those risks differently than in the world, which means in the investment side, the government issue a non-tradable government bonds, which held a big subsidy within them. Over the years, the government reduced the support by the non-tradable government bonds, and today there is only one instrument that is getting 30% of its assets and is getting such a support from the government. All the other instruments, which is life insurance policies and provident funds, are not getting any kind of government support regarding the investments or the interest rate. In Israel, there are two kinds of way dealing, or the market developed two kinds of way of dealing with the pension risk. The first one is by pension funds. Pension funds which are based on a discipline, which means it's a mutual basis insurance, and the risk, all the risk in the plan are upon the participants in the plan. The second one is life insurance policies, which gives you a guarantee regarding all three out of the four risks, which means death, disability, and longevity. Regarding the investment side, it's a free investment, and you are getting the interest rate upon your investment. I would like to emphasize something that is unique to Israel, which is the longevity. In Israel, I think, as I know, it's the only country that gives full longevity insurance starting your entry to the labor market. In the world there are all kinds of longevity, but in most cases you are getting such a guarantee starting age 60 and so on. You can buy it, but you can buy it only from certain age, which means 60 and so on. In Israel, if you are getting to the labor force at the age of 30, for instance, you are getting a guarantee, which means you are getting a guarantee of something like 60 years. Over the world, it's something like 30 years, half of the Israeli guarantee. It's a big issue in Israel. We cannot get any reinsurance for this risk because no one knows really how to deal with it. It's a big issue, and we try to manage all kinds of ways how to deal with such risk of longevity. The other risk, which are death and disability, is almost regular insurance that we sell on a daily basis. It's not something that we cannot deal with it. And as a participant, you can choose to buy either pension plan or life insurance policies, and the right mixtures is upon your degree of risk, hate, or love, which means if you want to get a full guarantee, you will buy a policy. If you would like to share all the profits or losses of a pension plan, you will buy a pension plan. We think that the right mixture is something in between, which means something like 50% in a pension plan and 50% in the life insurance policies. The pension plans in Israel today are considered young because we're talking about something like started 1995. Just for the record, in Israel, all the pension plans up until 1992 were only for employees. No one else could join those plans. And starting 1992, Clal and other companies issued disciplines that were appropriate for all the market. We see that one of the things that we try to deal with is the longevity risk. Longevity risk, you can deal with it in several ways or solutions. The first one is to increase the contribution rate of the participants in the plans. One of the things that we see starting, for instance, in the last 15 years, the longevity factor that we use in the pension plans or in the life insurance policy grew by something of 35%, which means that if you bought a policy, in life insurance policy, at something like 1995 or up until 2004, you are getting a much better longevity factor than the one you are buying today, and the difference is something like between 25 to 35%. That's because of the longevity and all the updates the government is doing in longevity. In 1995, the government established a board of actuaries to come with a right analysis of the longevity in Israel. It's based on the social security, on the pension plans experience, and the life insurance policy. It's not the same population, so for all kinds of instruments, they set other kinds or other numbers of life insurance or in longevity. So one solution we think that the government should take action is to increase the contributions to the plans in order to allow a much flexible way of the pensioners to deal with reduction in their pensions while they are getting their pensions from the disciplines or the pension. The second is, in some cases, there's a market of swaps that can be done regarding the longevity, which means that you can relate with companies or other organizations that have a positive correlation with increase in longevity and try to issue them or to sell them the risk of longevity. One such action is to address a municipality which has a high rate of pensioners and try to issue them a longevity bonds, which is you're getting one rate of the bond, and as the longevity goes higher, the interest rate in the bond is going higher also at the same degree. Others are the pharmaceuticals companies, also in that case, by bond issuing or other contacts, financial contacts, you can deliver some of the risk regarding longevity to those companies. It's a very early stage of the market, but as I see it, it's something that either the companies will try to come up with a solution that will give a full guarantee that they can give to the participants over the years. Either the risks in the pension plans will go back to the pensioners, to the participants, and they, over the years, if a crisis will occur, I think the government will have to come with a solution in order to maintain a reasonable life for those pensioners. There's another, it's a bit from the side, but there's another issue in Israel regarding the pension, which is something regarding the last few months, is what is the role of the employers in the system, in the pension. Over the years, we see that the employers took the risk of the pension schemes upon themselves. Afterwards, when it was realized that they cannot take it and it's not the right market player to deal with such risk, they slowly opted out from those pension schemes. But today they deal as a big agent, insurance agents for their employees, which means they conduct all the RFPs, they conduct all the benefits and other terms that the employees will get while they are working at that employers. And the government today is trying to issue a legislation that will take out the employers out and will give the full decision and choices to the employees himself. In that sense, one of the things that will happen in Israel, as we predicted, is that the employers will opt out from this market. Today, they are a very strong player in this market by getting very good benefits from the employees. And as we see it, if the government will take them out from the market over the years, we see that there will be another damage for the pensions and the participants, because most of the benefits they are getting today will become much lower than they are getting over the years. That's the second issue of employers in the pension schemes. We see that most of them act on a basis of trying to give their employees a full social benefits, but some of them, when they are seeing the risk that includes or concludes in those plans, what they're saying is that the only commitment is to the contribution they are making to the plans, and that's it. From that moment on, after the contribution is done, the full responsibility for the plan is the pension plan and the employees on their own. Thank you. One question?
Questions?
I have four common questions.
Four.
I am Anna Kadir from OECD. So the first thing I would like to say it's about your point of view of this scheme. I think that what we have seen in OECD countries, that many countries have moved towards DC schemes. I don't think that this is the only way to have life expectancy links in pension system. And many countries have shown that they can do without moving to DC scheme, and doing this, for example, some countries have adopted NDC schemes that are based on a pay-as-you-go way of managing the pension system and the pension risk that is virtually works like DC, but they are not DC. So they work on a pay-as-you-go basis. Or countries like Finland and Portugal have linked explicitly in defined benefits, the pension benefits, to life expectancy by introducing an adjustment that is based on the cohort on the life expectancy of each cohort reaching the age of 62. So I think that the issue of DC versus DB is very complex, and there is not only one way to deal with a life expectancy risk. So this is my first, and especially because this raises the question, who has to bear the life expectancy risk? I think this is the issue. What is the optimal degree of sharing the life expectancy risk? I agree that with DB, the life expectancy risk was borne by employers or provident funds. But now, as I said, I don't think that there is only one way to deal with this risk, and many countries have shown that this can be done in other ways. Now, the other point is more a comment. Is you dealt with the different risk that can be seen within a pension system. There is one missing, that is the labor market risk. Labor market risk is unemployment and childcare. So before we saw the position of women and labor market, many pension systems in OECD countries have credit for unemployment period or childcare period. Of course, all countries that have DC scheme, this is a question of solidarity, they don't deal with this kind of risk. So all the systems that have DC scheme cannot cope with the risk of losing period or spending period out of the labor market. And this is an important thing to say. And Finally, what do you mean by higher state funding of contribution interest rate? Do you mean that...
The percentage of the contribution today are something like 20%
Yes.
out of the salary.
Yeah.
What I suggest is
To
increase.
I thought I had understood this. I was not sure. And this is what, we have been involved in talking about pension reforms quite a lot during this the last months at the OECD. And of course, one of the things that we decided not to do in general is to advise countries to increase contribution rates, because this is a question of looking at how things are going about the economic growth, and increasing contribution rates can be seen like increasing taxes, and this can really make economic growth even slower. Thank you.
Just to clarify, in Israel there was a system where the government asked the pension funds basically to invest all the proceeds from the pension funds, or the premiums, or however you call it, in the government bonds. It was 93%. Then it went down to 70%. Then in 2003 it went down to 30%. Okay. These special bonds, earmarked bonds, they have a somewhat higher than market rate, 4.8%. It is indexed to the CPI, and it's a kind of, if you want, it leads stability, some anchoring the rate. And what Rami was proposing, to increase the rate from 30% to something like 40% or 50%, so that it will be the rate of return will be somewhat higher, and yes, this is what he meant.
I'll get to what. Yes, answer. The first comment regarding the DC or the DB plans, I think it's a matter of the political state of structure of each country. Because the experience in Israel shows that even though you are building a DB plans submitted to all kinds of changes, when you are setting a legislation, who will be the board or the player that will decide whether to update it or not, over the years it means that either you are not getting the right decision because you are unable politically to do it. And I was witnessing such an event in Israel, for instance, in 1998, when it was needed to update the pension plans, all the pension schemes in Israel, and the unions wouldn't let us, even though it was justified. So, having said that it's a DB plan subject to all kinds of changes, it means that it's a discipline. That's one thing. The second is, if you are not doing it in the right pace, which means over the years you can accumulate deficits in the plan. So that's the pure solution, as I see it.
No, but I agree. I see your point of view. My point of view is saying, because in your presentation you said that the DC scheme allows also a better functioning of the labor markets and on the pension system.
Regarding only the transitions of labor.
But I know. But my point is that this is not the only way. It's just a comment. It's not the fact that there is one that is best than the others. It depends, as you said, on a particular context. I think what we say is that should be a diversification of pension risk, and DB has shown, particularly during the crisis, that have been problems also for them, especially in what we call the solvability ratio. In many countries, many OECD countries they have lost a lot of money. So it was not. I was not saying there is one system that is better than the other is that there are other systems that work, and this should be acknowledged. This is the only point.
Okay. The second thing is my proposal to increase the contributions. It holds two kinds of propositions. One is today the employees set a contribution to others, for which we have scholars funds in Israel, and the employees contribute 7.5% from it, so we can divert those contributions to the pension plans. In that matter, the overall expense as seen by the market and the employees would not change. That's one thing. The second relates to what Avia said, and the idea is to give a government net to the interest rate in the pension funds. In that sense, you are getting one. On the other, on one hand, you are getting the pension funds in the market, in the capital market. On the other hand, you are getting stability given by the government over the years, which means that you are giving a net on an individual basis over the, let's say, 35, 37 years of accumulation in the fund, and in that sense...
Yes, I thought it was the contribution rate, but this is,
Okay. Thank you. Thank you. Yeah, sure.
Yes. I have a question about the longevity guarantee that you were talking about, and it's a very interesting issue because there is a risk. It's a small risk that longevity will be very, very large, but the risk is there. As a rule, longevity increases in some known pace, but there is a small risk that there will be a medical breakthrough, and then that longevity will increase. We don't know by how much. So it's going to be very good, but it's not going to be good for pension funds, etc. And I have two questions about that, or maybe comments. The first comment is that this is called, I think, something like tail risk, and that in the last financial problems that we had, the problem was that this kind of very small risk materialized. Very small risks that have a very high cost. And the question is why would anybody want to somewhat try to insure this kind of risks? So this is okay. And the second comment that I have here is that, and I think it relates to what we are talking about here, if longevity increases dramatically, this is going to be a very large social change. And it will induce many changes in employment and in lifestyle, in society, maybe even in fertility, who knows, retirement age. So this is something for the society as a whole to deal with, and maybe not for insurance companies try to guarantee a small piece of the action here. So maybe you shouldn't be, on this kind of general grounds, you should not be involved in this kind of problem, and just take some kind of clause in the insurance scheme that if something happens to the longevity above this and this, then you're out of it.
So, as Shai said before, one of the things we are considering doing is opting out of the longevity guarantee and to minimize it to something that is already in the world, which means to give you such a guarantee only from a certain age and so on. But that's one thing that we're trying to do. The second is that we do not see the government take any action or doing anything regarding this risk, but as a private company, as we see it, if any drastic changes won't be done in this matter, I think the industry, the whole insurance industry in Israel, maybe in the next year, will opt out, will go out from this kind of guarantee and leave the pension plans to give the plans without any guarantee regarding longevity in Israel. That's something that, as I see it, is going to happen unless the government will come and take actions in order to deal with such risk. But I think you're right. It's a very big risk we are taking today, and we shouldn't be doing it in the next years.
I actually want to follow up on, I think, Anna's question. I don't think you really addressed. I mean, there is a broader issue of who bears the risk, and at least this suggestion you sort of hinted at of raising the government sort of safety net by maybe increasing the proportion that is with the fixed higher than market rate may somehow sort of at least reduce at least one sort of risk. The other one had to do with the risk of being out of work or out of the labor market, and I wonder whether you can say, this is a societal issue, of course, but whether you can say something about the state of this situation now in Israel, whether it's unemployment or being out of the labor market because of childbearing and so on, and whether you sort of have any thoughts about that for the future.
The government in Israel stated out what are the risks which should be covered in the pension plans. This does not include unemployment and does not include other risks. We, just for the sake of the interest, we try to issue an unemployment policy in Israel. One of the big issues regarding this thing is, first, the moral hazard is very high in such cases. The second, because it's market related, in case of a crisis in the market, you are getting a huge sum of demands in that policy. So, and what we try to do, we try to say that, okay, we'll give you the ability to claim the policy only once in 5 years, for instance. But a true solution, economic solution, as we see it in the private sector, you are giving him an insurance, but it's not a full insurance for unemployment. The moral hazard is very big in such cases, and your ability to go after and to send investigators and so on to see that it doesn't work in other places and so on is very high. So the government didn't state it as something that you should give them insurance. I think in the state point of view, that case should be covered by the Social Security. That's the reinsurance as the government sees, is not in the pension plans. So the solution today is Social Security, not private sector, regarding unemployment and also...
So that we have said about the effect on the pension.
Excuse me?
The effects of being out.
Ah, okay. You can contribute to the plan, but out of your own pocket.
stable in its support to the market. This 30% is not going to be changed. Although I heard Mr. Spivak a few months ago in this university, we had another day, and he said that the government is not so consistent. Sometimes they are more involved and sometimes they are less involved. I believe that the government will increase its involvement in the market after they decided and they did the reform in the 90s and in 2003 in two cases. The first one is really financial crisis, like it was in 2008, and then they came with the safety net at the end of 2008, and this safety net is full of holes, and it's not really a net. Although the market since then improved in something like 40% in 2009 and 10, and it's improved the situation a little bit. And the second event that the government will increase its involvement is the case that Mr. Spivak mentioned, something that will change in the life expectancy dramatically. We'll find medicine for few diseases and things like that. But on the other side, we see the catastrophe in the nature, so maybe it will balance, eliminate it. But anyhow, these are the two cases that I can see that the government will increase its involvement. Otherwise, the government will stay with the same involvement that they have now. And I believe that they did really a nice reform in the last decade in order to balance this market.
Just one thing about this life expectancy issue. There are countries, as I said, that have, and there are very few, astonishing, that have moved to an indexation of pensionable age on the basis of life expectancy. So increasing life expectancy automatically would increase pensionable age. These are Denmark, that is at 67, Italy, starting from in 2020, and Greece with the recent reform. France has increased the contribution rates in a way that, according to life expectancy increases, people have to work longer. Okay? But the main point, as I said, and I think it's really the issue here, is how far should this policy go? Because the main point in pension debates at present are sustainability, financial sustainability, and adequacy of income, of retirement incomes. Now, if you cut benefits so much that you push low-income workers on and so bad level on adequacy for their retirement incomes, you have to pay on other pockets. So you have to take money from the safety nets. So what you earn on the life expectancy gains, you risk to lose by cutting, by spending more on safety nets. And this is a really important issue for low-income workers. And this is why the life expectancy links to pensionable age seems more and more reasonable in OECD countries as a way to look at the life expectancy problems in the future.